Thanks for joining in, guys, on yet another Sunday evening, or at least here in London. I think you guys know the drill now, but for those who may have been tuning in for the first time, I'm Bogdan. I'm one of the junior traders here on the London trading floor. And we're doing this Axia After Hours stream of just talking of just various topics. Points and events that may be happening day to day. Things perhaps we're noticing on with people on the floor, on the course, on the some of the senior guys. Hopefully shortly we're going to have someone else for an interview as well, perhaps next week, and we're just going to try and build this along, build the Sunday streams along with us. So how you guys doing? John B, thank you. Good evening to you as well. Yes, we're doing, we're going to talk about everything today, market profile, order flow, footprint, for sure. And this is actually the whole point of today, actually going back to basics. And maybe the first 5 minutes is going to be so ultra basic for some people there, but I have to say, there's quite a lot of people who come onto the course or come onto the floor later and say, I'm an order flow trader, I'm a price ladder trader, I trade that kind of thing. But then when they when you talk pure mechanics of how the ladder moves, when you talk about limit orders, market orders, participation, the sort of the nuances, the little details of the price ladder, you can sort of understand that there's no sort of logical A to B. They make quite a few assumptions and they jump in their reasoning in understanding certain things. And that's quite important as well. When you of course, if you label yourself as an order flow trader, you trade footprints or something, you have to understand this inside and out. So, if you do consider yourself an order flow trader, as I said, the little beginning, the first 5-10 minutes, maybe 20 minutes will be a bit slow, but it's good just to recap the ultra basics, and then we'll dive into something a bit more interesting. One thing I would like to do is, let me bring up this is Excel sheet here. So I made this a little ladder for myself, very sort of impromptu, let's say. But I thought we can really be a bit more descriptive in how we talk. So, and in fact, let me just bring up so you can visualize this a bit easier. I've got this recording on just from a random, from someone on the floor on the random recording they had, because the recording isn't so much important on what we're recording, just so we can have a bit of, just a bit of color on what we're talking about. So, starting on bare bones, it shouldn't be a surprise, but for those who may have just looked at trading futures at the beginning, you have to always remember, you have to understand that the futures markets, and generally all markets there, are not actually invented for you guys to just make money or easy money or to to gamble away money or anything. They're not there to as a way for directly, let's say, as a risk-taking tool. In fact, they're the opposite. So futures markets specifically and derivatives were invented to hedge risk, and this is the reason why they exist. So this is they existed for institutions, they existed for let's say oil refinery companies, perhaps companies who are very big in the food chain industry and are reliant on meat prices staying stable for them. In the commodity space, perhaps there's retirement funds and so on have to lock in certain bond prices and bond yield and so on. So you should always remember the fact that futures markets, and generally all markets, but future markets especially, are not there just for guys like us in and around trying to grab a few ticks here and there and try and do it on size. And then that is the trade-off that is the trade-off of us participating in our risk, in effect providing the liquidity and helping to help the markets identify value. Because one of the other things, of course, the reasons market exists, and this is why any sort of capitalist economy benefits from markets, is because markets are there to find a mathematical value, an actual value on the price of X, Y, and Z. Otherwise, it cannot be done. And good or bad, if that's the right way or wrong way to go about it, that's sort of besides the question. It's the sort of the best tool we have collectively as a civilization to ascertain market value. So do not forget that we're one very small corner of the world when we trade futures, and this is the kind of mentality you need to have when you understand certain market moves, the reasons why people are actually in markets hitting it with size or something. It's not full of, there will be traders like us, moving the market perhaps in some way, in a very localized way, but far less than you'd imagine. And a lot of the time, of course, the market's not going to care about your one or your two lots. They're going to care about institutions or oil refineries or gold miners who come in and they call up their accounting department, whoever, and say, look, we need to lock in certain price for X, Y, and Z delivery. Call up the bank, call up your interdealer broker, and so on, and give me execute that order and so on. They're not there perhaps to make to just speculate and trade on prices the same way we do. So I feel like I want to highlight that just from the get-go, and that'll be a bit more relevant as we look at the footprint and charts, and we piece together different plays. But I feel like for a lot of people perhaps who are new to trading, they just assume that everyone who's in the market at that time are day traders. And even if they're not day traders, even if they're long-term players, they're hedge funds who hold positions over quarterly, over annual positions, or so on. They're not all there as guys coming in for a quick buck. The speculators are very tiny. I think from what I've seen, a statistic from the CME, I think they're only about 20% of the market, including everyone, including the the hedge funds, big prop desks, whoever. From a speculation perspective, 80% of the rest of the market are there for a different purpose, i.e. they've got a hedge, as I said, their oil exposure because they're a refinery company, a food company involved in the food chain, in the meat packing or whatever. Perhaps it's involved in in lean hogs or just using something very specific. But that's what you should always keep in mind when you're looking at the price side. And this is when people interact. Everyone comes to a central exchange, okay? And this is where it differs a bit from people who trade on stocks, because on stocks you have various dark pools and various different exchanges. When we trade on futures, generally the one contract everyone around the world trades through, and that is what they see here on my screen, the price ladder, okay? And this is one thing I think people really forget, well, not forget, perhaps get confused at the beginning when they see the price ladder. The price theoretically can't so here you have your best bid, shall we say. If I just write that in, best bid and best offer. It's not so much that these best bid and best offer can it's not that they can match, like they have to synchronize and then they somehow match, okay? That is not exactly how it works. What it means is, now if someone's seeing this and someone buys at market, he has to go to the market and lift the best available offer, okay, which would be this box in here, 190. If he lifts 2 lots, then he would be long 2 lots, and then he would eat that liquidity from someone who has an offer here, 190, and then of course we would then go to 188 on the ladder. So he's eaten 2 lots. That guy who has lifted 2 lots is now long, and whoever has put all of these offers here, he is now short. So they've exchanged. But one has been passive because he's waiting to get filled, and one guy has gone to him and taken his offer. Okay, so that's how we define those two participants. One has been aggressive to go into the market and eat through that price, and one has stayed there passively. And to reiterate again, if I just quickly minimize, this is what we see on the footprint. Okay, so footprint is not. It's not that it's perhaps it's too simplistic to say it's just a time and sales that's on the chart. It's a bit more nuanced than that. But this is the kind of orders that we see on the footprint. It is people going to the market. Okay, they're going to the market and they're either lifting the next best available offer or hitting the next best available bid. And this is what you see. So let me here. So when we were imagine this. Imagine this price here. If you can see the 1,713. Imagine this being the bid, okay? And the offer is not in this column at that time when the market was trading, because we're looking at this 5-minute chart. So obviously the bid and offer was moving up and down as we've traded in this range, okay? When the bid and offer was moving through up and down through this small range, it's always staggered. It's staggered because the same way how they're staggered on this. If I now losing my charts, but sorry, losing my Excel. They're always staggered in this fashion. So if you would imagine here, this 173, someone would have to be selling into this, hitting this bid, but the offer always stayed at the next price here. So never forget, we're never matching the bid and offer. They physically can't match. The mechanics don't work in that sense. That the bid is always remaining here, and then the offer is always the next tick above, at the very least. If we're talking about liquid markets, if the market is extremely liquid, then obviously the bid and offer is going to be much wider. But anyway, and imagine here the bid is sitting and someone was selling 1,713 lot, and then he cleared that price, and then the next best bid was down here at 400 and 60, and here at 461. And by the the bid being cleared here, the offer has stepped down into that price, and now we are now bid 09s and offered 10s. So for now, the buyers should start lifting. They're no longer lifting into this box here. Essentially, they're now lifting in this box here, 1,105, and this is how we exchange. So you're always looking at it in a sort of diagonal sense. If we're stepping down, so you may ask then, how did this low get formed? Or even better, how did we form this low here? Okay, because when we cleared out this order, when we cleared out the 461s, it meant the bid stepped down another price, where you can see my arrow, and then we were offered at this price. But no one at that instance actually sold even one lot to form anything here. We immediately went, someone lifted this offer, and then immediately bought again, and then we just kept on going up. For example, that's how that low would have got formed. And I feel like for those who understand that mechanic very intimately, the footprint should make sense to you, because you're looking at the orders transacting through the best bid and offer constantly. Okay, and they're always staggered. If you can see me doing some hand gestures, but they're always staggered. Okay, they never perhaps match, and if they look like they match, perhaps that's just your software looking a bit wonky or something, but they never physically match, because the bid may get taken out, all those contracts get eaten, and then we step down. Okay, I also see a question here from Big Toasty. Why not just focus on one market? There's so many opportunities. Okay, that's a very good question, and it's something I'd recommend. Again, this is actually one thing I even said to someone on the course. When you first start off, obviously you don't want to pigeonhole yourself into trading one market. You want to have the experience of trading many markets and different strategies, not expecting that you're going to make a quick buck and you're going to be amazing from the start. You want to go through the process of investing time to learn things very deeply. And at the same vein, you want to also look at just one or two markets. You don't get confused, and you don't split your energy levels into too many different places. But it very much depends on the kind of edge you're trading. Big Toasty. So if you're very news-based and macro-driven, like myself, I've identified that as one of my core strong suits. You never know what news is going to come out, and therefore the biggest thing you want to do is obviously trading. You want to be trading the news on the most relevant market, and this is why I have so many. And for me personally, I just love to see all these different correlations coming in and out. So if I have, as you can see here on, again, this is someone else's, but my screen, I've got like 3 screens of just ladders. I'm not trading all of them. I'm only trading a few markets, but I'm looking to see correlations. Maybe one market has a heads up on something, you never know, and you want to keep track of it. Maybe if the risk assets are moving a certain way, maybe they know something, maybe they're thinking something, and you want to be processing that in the back of your head. So it depends very much on the kind of edge you're trading. And that's how we sort of, again, going back to the course, because I know there's a few people here watching. That's one thing you'll be discovering as you go through it, of sort of building these things brick by brick. Because currently you're just understanding how these Lego pieces sort of fit. Algo market makers, and by extension, what are the participants in the futures market? Okay, so you have your market makers. Historically, obviously, they were human, and they still are. And it depends what we decide. It depends what we classify as a market maker, because there's different classifications. Theoretically, by you posting a limit on the bid or a limit on the offer, regardless who you are, theoretically you're making a market to be very loose with the terminology. Okay. Obviously, there's this whole thing about market maker designations and so on, officially by the exchanges, but theoretically you are making a market in that sense. And when I think about them, they're neither here nor there. They're just another participant that are here. Theoretically, you know, they should provide a lot more liquidity than other markets as they've thickened up over the years. Perhaps that's a good thing. But you know, the thing about liquidity is that it's never there when you need it, no matter what participants you have, and that'll always be true. So I know there's obviously this. I'm not sure if this is what you're asking, Big Toasty, so I don't want to put words in your mouth, but obviously there's a bit of and this is the thing I want to talk about. There's a bit of sort of this theory that there's these evil algos, market makers, evil algo market makers, brokers who try and run your stop or whatever. And there's this variation of like people trying to just do various things. But again, let's talk about participants. The participants mainly in the futures market are not there they're there to hedge an asset. They're there to get business done for different reasons other than speculation. If an interdealer broker gets called up by an oil refinery and says, "Hey, we need to get we need to lock in 10,000 lots of oil or whatever," it's probably too many, but let's stick with this example, in September. So fill me on that inventory, and obviously that interdealer broker will give them a bid and offer, and then that interdealer broker will then have that risk. And the way they can offload that risk is in various ways, by communicating with other brokers or whatever. But then they have the option of coming to different places like the futures market and offload the risk by just coming at market and buying or selling it. If they would do that, there's a problem, because they'll start moving the price very, very, very aggressively. And by moving the price aggressively, actually does create opportunities for us speculators who are there to either take the other side, join them, whatever, it depends who the trade is. But that creates opportunities, and that may create too much of a big loss for these execution brokers or people who have to execute these orders. And this is why through so many, if you talk about people in industry, I'm sure perhaps there's people even watching now, is that no matter what market, stock, cash, futures, whatever, you're always going to be graded in some way of how well you can execute in the market without moving the market price adversely away from you. Because if you're coming into a market that's as thin as, let's say, if I show you gold, or okay, it doesn't seem to want to play ball this. Okay, here we go. So if you come into gold or oil, but just imagine you have a very thin market, and you come in and say, "Hey," someone says to you, "You gotta get, man, we've got too much exposure. We're long 3,000 lots of gold. Get rid of it." You're not gonna just randomly come in and just sell it at market 3,000 wipe, because you're literally gonna wipe out all of these guys. You're gonna wipe them out, and you're gonna keep eating through the book. Until you get filled, and that price will be not only gigantic, but you're going to lose a lot of money. And I'm sure, I don't know this officially, I'm sure there's kind of like exchange regulations or like regulatory things that you can't like do these crazy price moves. And if you do that, if you're an institution, you probably have some kind of heat coming down on you, perhaps, I assume, but could be wrong. But anyway, doesn't matter. They have all incentives to not move that price. And this is why you have these kind of various order flow where people might iceberg, or they might absorb, they might be very smart on how they try and get filled, so they can get filled all at one price, or as close as possible to one price. So again, this is why you have to understand these little nuggets of participation and how that drives their execution, and how that you can drive your strategy from that. So Stefan, yes, I see your question about monitoring resting bid and offers on the footprint historical chart. Have you ever used this historical chart to give you an edge on seeing participants adding or removing orders across the chart? Okay, very good question. And yes, there is an edge, but very simply, where are we now? Not that we are actively doing this 100%. And okay, this is gonna segment again into one thing I'm going to talk about, which is when we start, everyone on the floor, everyone here on the trading floor, no matter how they trade, they're going to be 100% price ladder focused. You might see it on some of our videos. If you ever visited the floor, everyone has literally like screens and screens of price ladders. Everyone is built from the ground up, from the price ladder this is our main edge. On the course, it's all about price ladder, and then you derive from there and so on. So because we have our eyes on the price ladder like 24/7, we already see how the order moves into those resting bid and offers just naturally by being at our desk and observing it. And since we're there, it's kind of like we don't need so much to have that historical resting bid and offer, because you see it. Not to mention the fact that all of that is going to be crazy difficult on system resources and storage, but that's a minor point. But we're here. But we're actively watching the footprint, and we're actively watching the price ladder. And for me personally, and a lot of people on the floor would agree with me, is they're joined at the hip. They're not two different things. And I think some people come in and think, the price ladder looks scary, it looks too confusing, it's difficult, I'm just going to use the footprint charts. And fair enough, if you lean on footprint charts over time, that could be more of your edge. But the reason why I never separate the price ladder in my streams from footprints is because you can't. It's if you are footprint only, you don't understand the price ladder. All these things I've literally just talked about for the entire stream, you will not understand deeply. And there's so many inconsistencies in your thinking and your understanding of applying the footprint in the correct way by misunderstanding the price ladder and misunderstanding how participants physically, mechanically, and interact on the futures exchange. So yeah, it's a combination of both. We watch it, and basically it's the same thing because we're watching the price ladder and footprint. So in effect, we have created the same thing. And whether we're talking, do you have an edge of seeing participants adding or removing orders across the chart? Yeah, definitely. And this is the thing we're always looking out for. Like, has the book changed? Is there someone unwilling? Perhaps on day one, there was someone who's very willing to, make a market at a certain price, and the next day he wasn't there. And this is, in fact, let me show you. It's funny how some of these questions actually fit very well into some of the stuff, but where is my... Okay. No, that's fine. Okay. So let's talk about this. So this is where I feel like taking an extreme, and I know we talk about it sometimes on the floor or other stuff. When we take an extreme example, which perhaps day in, day out may not help us so much, but when we take an extreme example, because the extremes simplify situations, it's easier to talk about a concept, and if you understand it in the extremes, it's easier to understand it, when you apply it to more nuance. So, if you look at this chart, this is a okay, again, seems so. This is the chart recently, a few days ago, of something of the US 2-year bond. Okay, it's a very liquid market. It's very thick. The range on this market's tiny most of the time, other than obviously this weekend. The short end moved massive, and that was great. That was amazing to, for the market to finally unlock and to move. But this is the thing. If you look at, this is much easier to see in thick markets than in gold or oil, but it is the same thing happening regardless of the market, just because the liquidity is different. It plays out, it looks differently. But this is over a series of days in the US 2-year. Okay. And then you can see every time we've lifted into this exact level, this exact price, there was no one willing to step through that order, that liquidity, and there was someone on the offer, let me tell you now, who was just stuck there. He was stuck on the offer, and no matter how many, even though there wasn't that many, no matter how many buyers came in to just lift him, lift, that guy did not get out the way. Okay, he was just there selling. Okay. On the flip side, when you have this like tight level, there was someone sitting on the bid, and there's sellers selling into him, sell, and he just refused to move. And you can keep track of this, and this is one thing we talk about on the course a lot, depending which one you're looking, but the footprint course as well, and again on the graduate, the main career one, and also the guys just generally when they continue on the floor or remotely. One thing we try and explain is documenting how the book changes over various days. Okay, so if you notice that there was a guy there sitting all day for 2 days, 3 days, whatever, and there's people selling to him a certain amount, cool. But what happens on the day he is not there? He is perhaps now full, he's had his meal, he's taken as many contracts as he needs, or he just stepped out the way. And when the market gets to that level, the price action is very different. It's much more active. There's aggressive sellers, and let's just say there's other things going on. There's correlations telling you that the market's going to keep going lower, and you've pieced all these things together, and then you know that that is your edge because that guy has stepped through, and you can get very good prices by also selling into it when the opportunity is ripe. So again, using your thing is the edge of seeing how participants add or remove orders. It's not so much that they add or remove orders, but understanding when they are placed there to participate or not. And again, this is what you see in all markets: gold, oil, gasoline, crazy fast markets, yeah, Bitcoin, any market, doesn't matter. I'm just giving you a really easy example right now in the US Junior, just because it's very easy for us to visualize. It's nothing crazy going on in the chart. It's just a very simple explanation. Is through understanding this participation, there's active participants. There's, when you buy, someone has sold to you. When you sell, you've bought it from someone. Others are people doing the same. You have to always question, why is someone doing this? Why is he doing that? Does he know better than me? Do I know better than them? How does that work? And again, you have to remember, not all participants are created the same. Most are not speculators, and you sort of, by just even knowing this, without me explaining even further, it will sort of give you a more nuanced version of how levels are created, how structure is created, how it's sort of like, coming perhaps, shall we say, from a retail education. There's a lot of people who, come in and just say, okay, this level, okay, my strategy is breakouts. When the price goes above it, I'm just going to buy. But you're missing so much nuance, so much depth to trading that if you look at some of the bigger technical trades some guys have done, let's say on the profile, and he shorted a level and he sold it, you're thinking, well, what did he do? He took a breakout, he shorted it. I mean, that's literally what I do all day. Why am I not making money and he's making like ridiculous money? It's because it's too one-dimensional to say, okay, level there, we're going to short that guy. From the outsider looking in, if you weren't in his brain at that time to know exactly what he's looking for, and you just walked onto this desk and you see him short that level, you'd be like, okay, he shorted it, and then you short it, and then he gets a good trade, you don't. It's because this whole entire the picture, the clues, the nuance he's built, he's pieced it from so many different things, from so many different places, that he understands that entire area so differently to what you do. He's looking out for he's thinking, what are the participants doing? He's playing the meta game. He's putting themselves in their shoes. If there's one thing I want everyone to walk away with, is understanding just to improve your trading from one thing. Always put yourself in the shoes of the other guy you just sold to or you just bought from. Always put yourself in those shoes. Again, it'll be different because you just don't know who you're buying and selling from. It could be an algo who has just market maked and he is hedging his exposure, so he's very different participation. It may be some other speculator, it may be a hedger, it could be anyone, but just always be thinking in that process, because that's going to help you to just build this fractal mentality to just, you understand the price ladder and how people are positioned, but then you can think of more long-term, positioning and so on. Does lack of liquidity create, and when I say liquidity, okay, let me start using what I have here in the background. And when I say liquidity, do I mean, all I mean by that is how thick is the book, bid or offered, okay? So very liquid and very, you can't see that because of the chat, or very illiquid as the gold, okay? So the liquidity shifts a lot. It shifts a lot intraday, cash or out of cash or whatever, and it shifts over time. Now, the most obvious examples of that is two things. One, if anyone was trading Euro stocks at least before the pandemic, but I think now even before the Trump-China, war or tariff war, I think when the volatility in the S&P was so tiny and you had like tiny range days and the equities were very static, the Euro stocks was crazy bid offered. It was bid offered like 2,500, 3,500 every price, and now the book has opened up and it's now like 500, 600, 700 bid and offer consistently over the past year and a bit now. So that is a very different market, and this is why, guys, and I see this from new graduates coming in or new guys on the floor or whatever. And this is one thing, and this is the thing, this is kind of like, again, the power of talking to so many guys. And Alex said this very beautifully in the sense that the market state that you're in shifts over time. This may shift really aggressively, like we may go from high correlation environment, low correlation environment, technical environment, news driven environment, whatever. and so many things change. The book changes, whatever. And this is why you might find when you first start trading, all of a sudden you can't go wrong. Like you're like, oh, you find some trend following strategy, you follow it, you make a lot of money, and then all of a sudden it blows up, and you're like, oh my god, I've got so many, perhaps my psychology isn't good, perhaps the strategy is bad, Most likely what happened was that you were in the right environment at the right time, cool, but then the environment shifted to something else which you were not learning, you haven't adapted to it. And this is the one thing I really struggled with at the beginning, because I also took things very statically. Like I took very certain scalp trades. I took a lot of order flow trades and so on, or whatever, or breakout trades or reversal traders. But the fact of the matter was, I was suffering, I didn't understand. But then I realized you guys take a step back and just understand that kind of market conditions you are in. And one of those market conditions, because we're now doing a price stat and order flow, as Simeon said, understanding the liquidity on the book. That's it for me, guys, in terms of material. Perhaps at the beginning that was a bit more shall we say, really basic for some guys, but I feel like until you really go through every single nook and cranny and you really build up this picture, and this is why I wanted to take us on from from the extreme basics back to basics stream to just building it up to understanding how you storyboard that nuance of a level and making the opportunity ripe for yourself to get into that trade makes all the difference. And I was using it from the perspective of how I was several years ago, and the guys on the course right now, how they're thinking, oh yeah, I'll never get this, I'll never understand this. But if you understand the extremes, if you understand the basics and you piece it together and you think through it very, very logically, like, okay, I'm a committed seller, I'm a committed buyer. What are those guys thinking? Who's participating here? Why did someone just sell 2,000 lot into? Maybe he's dumb. Maybe I'm smart. Maybe he's another participant. And then this is how you're thinking things. So again, to those guys in week 3 of the course, don't fret. You will get there. And those guys interested in this, again, as I said, look through some of our YouTube videos and sort of understand how we piece these together. So. Okay, no, I'll wrap it up there, guys. Thank you so much, wherever you guys are listening in from around the world. I hope that was useful. As I said, go on the quiz. And again, guys, for those who want more Axia material, remember, the course is our flagship program. We're very keen on expanding the remote trading world, the futures prop desk, and so on. That is something that is underworks constantly. And one thing we're using the program for is onboarding guys. Not so much that we're using the same tools and methods, because obviously, but just so people come to the program, the development program. It's not even tools; it's the mentality. How do you approach things, and so on. And hopefully, people who will be onboarded onto that course, then then they can take funding trials, and we really want to grow a gigantic remote trading community from that. So thank you so much, guys. I see your thanks coming in. Sean, one tool be the ladder. Why? Is because, well, short answer is because the crazy amount of information you get from the ladder that is just irreplaceable from using the chart. But again, I'll add that to the list of perhaps things we can dig into a bit deeper. Okay, perfect. See you guys next Sunday. Yeah. Okay. All the best, guys. I'll sign off. See you.
If you find this video interesting, if you want to go deep into the Axia training method and how our trading team of 7-figure traders develop setups and strategies and how they learn to build the most profitable trades across all market environments, then join me in this workshop. Now in this workshop, you're going to learn 3 powerful steps we use to train all our traders on both our London and our Poland trading desks to help build incredible levels of consistency. How to predictably understand which setups work and which don't. You're going to learn our 2 main strategies for how we perfect our trade timing before we enter every single trade. You're going to learn the VEL concept, which is our one and only technique we use to leverage our largest trades. You'll also learn how to avoid trading setups that don't work, how to avoid those large losses, and our main method we use to identify them that saves our traders significant amounts of capital. Finally, you will learn how our traders use the power of network learning to find market patterns quicker than ever before, so you shortcut that learning curve. In the workshop, we want to program your awareness of elite performance, to program your ability to choose the right setups, and program your ability to be a consistent trader. So the trades that you execute become more simple and clearer. And I can tell you this, you'll never see the markets the same again. You'll never look at the markets with a narrow view of getting lost in all the noise and confusion. You'll take your first step towards a deep edge market awareness. I cannot wait for you to join me in this workshop. And I think you're in for a massive paradigm shift in your understanding of how to develop as a trader. So join me by clicking on the top right-hand corner of the screen and sign up for this powerful training workshop, or visit elitetraderworkshop.com.